Hello, greetings from Indonesia. It's an honor for us to present our result of the research regarding the financial issues. As part of the team with my senior associate professor, Mrs. Juniarti from Petra Christian University, please allow us to deliver our presentation, and hopefully this issue regarding the investor perspective will give beneficial information for all of us. The background of this study is based on Hasan and Habib information that the struggle of the company in order to earn or to get a positive response from their investor is not out of dated issue. All or majority of the research in financial, especially regarding the share price, will explain or will elaborate about how the company try to get a positive response from their investor. We assume that as a conservative investor, sometimes the investors only focus on the bottom line of the income statement, namely net income, in order to give or to evaluate the value of the company. But our study tried to try to analyze about the contribution of capital expenditure as part of the way the investor evaluate or value the company. So the literature background that we use, the first one is regarding the signaling theory, because by using a capital expenditure, the company tries to send a positive signal to the investor so that the investor can give a positive response to that capital expenditure. We use population and sample from Indonesian Stock Exchange because based on our previous assumption, especially from some of the capital intensive companies, we use Semen Batu Raja as one data that elaborate the contribution of capital expenditure in the increasing of share price, especially for this company, for this particular company at December 2020, by having a 12.5% capital expenditure, they can achieve or they can earn 100% share price at that time. Besides signaling theory, we also use capital spending theory and company life cycle or S-curve theory, because we assume that by using a capital spending or by using a capital expenditure scheme, any negative effect in the declining pace of the company will be eliminated using intention to have positive growth. So we assume that capital spending allegedly is one of the life cycle indicators that can be used by the investor in order to value the company. This is our research framework. So by having our capital expenditure, the company can increase their productivity, the quality and business process also increase, and the profitability can be manageable, and also the business risk can be controllable. So after they have a good indicator, yeah, from the growing issue, profitability issue, and business risk issue, yeah, hopefully, yeah, there will be a change, yeah, especially positive change in the share price of the company. As I mentioned before, that we use population from Indonesian Stock Exchange or IDX listed company, but uh, we do not use financial sector because they have their own scheme of capital expenditure presentation and recognition. This is our research model. Yeah, by using this one, we want to analyze whether the change in share price will be affected by any change in capital expenditure, profitability, and business risk. So our capital spending will be proxied by total asset and total fixed asset, while our capital spending growth is indicated by a dummy score. If the company have a growing indicator or growing uh, issue, so we will give score 1, yeah, otherwise we will give them score 0 for any negative or non-growing company. For financial performance, we will use return on asset, while debt to equity ratio is the indicator of the risk variable or risk issue. As I mentioned before, the change in share price will be indicated by Tobinski. After we run our analysis, so we came to a conclusion that from the first hypothesis, we can conclude that capital expenditure can be used by the investor in order to indicate growing of the company. So they can use capital expenditure as part of the increasing in share price. Okay, so companies with capital expenditure have a better foundation in order to have future financial performance. But there is a negative relation between capital expenditure with the performance of the company. And investor also will uh, negatively reacted to a debt-dominated capital structure company. So if the company have more debt, they will give them a negative response. The second hypothesis is concluded using this statement that there is a positive investor response for any of the growing companies. While the third hypothesis stated that on a negative or non-growing companies, the investor will have a negative appreciation. Thank you for your attention. We hope that this research can give a beneficial information for you. See you.